If you've been around the finance side of the internet, then you've probably already heard about the illustrious Warren Buffett. Some people consider him to be the most sustainable self-made billionaire ever. But how about the fastest? Well, that would be Jay Walker. Compared to Buffett's 55 years to join the Billionaires Club, Jay Walker did it in less than a year. He managed to launch Priceline.com during the dot-com bubble, and he became an overnight sensation. Unfortunately, that didn't last long. When the bubble burst, his seemingly infinite wealth came crashing down as well. But that's exactly why Buffett is still at the top of the list. He put the time and effort into his investments, and it doesn't look like this long-running billionaire is going anywhere either. Now that's the kind of wealth you'd like to build. It's no secret that the game of money isn't easy at all. It's highly competitive and merciless, and if you don't know how to play the game, you'd be out before you even begin. The problem with the majority of people is that they might dedicate all their time and effort to the game, but end up penniless at the very end. That's because they don't know the secrets to money making using more money. The long and short of it is that they don't know how to invest. Let's say you've been saving money with a spare $1,000 in your account. Compared to most Americans, that's already an achievement, because most don't have an extra $1,000 in their bank. Would you really be willing to buy another useless gadget or a pair of shoes you're going to wear once and then throw out eventually? I think not, right? If you think about it carefully, the best way to go would be to invest in it. The hot burning question now is, how do you invest your very first $1,000? Do you invest it in real estate or the stock market? What kind of stocks do you buy? Are $1,000 enough to start investing? Lucky for you, I'll be answering all of these questions and so much more. Now, let's get started with understanding what investing really is and how it works. Let me give you an example. Let's say you worked incredibly hard and saved $3,000. You have two options here. Either go to a Ferrari store and buy a luxury car to show off your money, or you can buy real estate like a house and rent it out. Well, the correct answer for the best investors would be the second one. For the real estate option, you'll be receiving at least $2,000. And if you decide that the $2,000 don't cut it for you anymore, you can sell the property and get back your initial investment. In reality, with real estate, the value of your investment might even increase, so you could sell it for a higher price. Now, that's how money makes more money. However, the reality is that you can't buy real estate for just $1,000. That's not even close to how much you'd need for a down payment. But that doesn't mean you can't invest that $1,000 somewhere else and let it work for you. The first option and probably all-around best way for sustainable investments is to deposit it into a savings account and generate interest. I bet you're now wondering, why would the bank pay me for keeping money in the bank? Shouldn't they charge me instead? Well, not exactly. You see, the bank is going to use your money and loan it to someone else at an even higher rate. Once they profit, they'd be sharing it with you. And that's generally how a bank works. The biggest problem with this strategy is that interest on deposit accounts is so low that it might not really be worth it. The best rate you could probably get is 0.8%. To help illustrate this, let's say you invest that $1,000 into a savings account, and in a year, you'd receive an extra $8. It's hardly worth keeping your money in there, don't you think? But you might also be wondering now why interest rates are so low on deposit accounts. That's because interest rates in general are low as of recently, since the pandemic had forced the Fed to lower interest rates. This was done to encourage everyone to borrow and spend money. Hopefully in another year or two, once we've bounced back from this recession, the Fed will continue to increase the interest rates again to 2 or even 3%. The second option for sustainable investment is to buy government bonds. A government bond is an assurance that is given by the government to raise money and support government spending. For example, the government wants to build a school, but it doesn't have the money to do that, so it issues an IOU. This is a piece of paper that says that whoever owns this assurance is owed this much amount of money with interest from the US government. It might not be this simple, but this is the gist of what happens. However, like most long-term investments, government bonds are heavily influenced by interest rates. Since interest rates are still relatively low, government bond rates are less than 1%. Like with deposit accounts, around 2 to 3 years ago, government bond rates were as high as 3%. This isn't bad at all since government bonds are known to be the safest investments you can ever make in your life. Now, we've just talked about 2 amazing, yet as of now, difficult investments that you can make as a starting investor. And before we move on to some of the risks that come with these kinds of investments, be sure to hit the subscribe button and like the video. Now, let's get on with the risks. As any great investor should know, investment always comes with a risk. If you're loaning money to the US government, what are the chances that the US government will default on its loan? We'd be assuming that the US economy would have to fail if the US government would go bankrupt. But it's difficult to assume that. That's why government bonds are considered the safest investments in the world. Unfortunately, the returns from government bonds aren't that big for all of you highly ambitious people out there. But ambition is always good in investing. If you'd want to make a higher return around 10 to 30%, you might have to consider investing in the stock market. I mean, Tesla's stock just increased by 721%. Can you believe it? So, if there are big stocks like this, why would anyone invest anywhere else when you can increase your profit tenfold? The answer is, and will always be, risk. If we go back to government bonds, there isn't much risk. We could even consider it risk-free to a certain extent. But when it comes to individual companies, there is a large risk that the company might fail, report negative earnings, or receive any negative news that can drive its stock price to the ground. Sometimes with individual companies, their profits and stocks are all dependent on public perception. Let's take a look at Apple and Tesla for example. Apple is a well-known and well-established company that has lesser chances of failing than Tesla. The stark difference, though, is that it has less room to grow than Tesla. And that's why Tesla grew 10 times more than Apple just recently. One great tip for all investors is to determine how much risk you're willing to take. As a reminder, be sure to only risk what you can afford to lose. If that $1,000 from before is all you have left, maybe using it all isn't the best option, because when things get sour, you'll be left with nothing at the end. But what if I told you there was a surefire way to minimize the risk in the stock market? That would be investing in an index. The one that's all the rage nowadays is the S&P 500, which tracks the top 500 US companies. An index fund would essentially invest in these top 500 companies. This means that buying a share of these index funds means you're also buying a small share in the top 500 US companies. Of course, out of them some will fail, while others will surely grow. Going by historical data, the average return rate for the S&P 500 since the 1920s was a staggering 10%, especially considering the times. Before I share my top 3 favorite index funds, I'd love to know your thoughts on these investment schemes so far. Do you agree with them being the top 2 options? Or maybe you have a few that you'd like to share. Feel free to let us know in the comments down below. Now, back to the video. My 3 most favorite index funds are definitely VOO or the Vanguard 500 Index Fund, QQQ, and the index fund created by Invesco. And finally, the Fidelity Zero Total Market Index Fund. I highly recommend these because they invest in pretty much the exact same companies with only slightly different results. But you might now be asking, how do you buy shares in these index funds? Where should you even begin? Well, first of all, you'd need a broker, someone qualified and knowledgeable enough to sell you stocks. Back in the day, it was someone you had to call and ask to sell you some shares. Thank goodness technology has developed quite a lot since then. Now, things are much easier and a lot more efficient. Some brokerage firms have even created apps so you can buy shares without leaving the comfort of your bed. Actually, more often than not, they have sign-up referrals so you can start investing right away. For all beginner investors out there, a popular side app is Acorns, where they have a friendly user interface that can get you started in investing easily and quickly. They even compile your purchases to the nearest dollar, so your extra change is automatically invested for you. Thanks to new age technology and a lot of great investment options, new investors can now start to compete with some of the biggest investors out there. There are a lot of tools and people to help you out with your first few investments. Just keep in mind that you should take things one step at a time. Thanks for watching, and if you want to learn a few more tips and tricks to handling your money, make sure to subscribe. We'll see you in the next video. Cheers!